students, welcome back. This is lecture 2 for chapter 1, and where we left off we were talking about the balance sheet. So I want to come back to that concept that I touched on during the income statement, which is around account categories and accounts. So if I flip back to the example of the balance sheet, you can see I don't just tell my readers I have $40,000 in assets, right? Because that wouldn't really help them. Think about it. If you decided you wanted to invest in a company and you said, hey, what are your assets? And they said, I have 40,000. You'd want to know more. You'd want to know what was cash, or how much was cash, how much was accounts receivable, how much was equipment, etc. So assets is a category, okay? Assets, liabilities, equity, those are categories. How we define the more detailed is accounts. So when we record transactions or economic events, we're going to do it at the account level, right? So balance sheet is the financial statement. Assets is the account type or category. And then cash is the account. That's a good example. Why do I care? Why do I need to know this? Well, it's going to be important how you know it. Why you know it, because this category is eventually going to define how we do our recording of the transactions. So think of this as a big drop-down menu with cash being the lowest place on the drop-down menu. All right, I said that there are 4 core financial statements that we're going to be talking about all semester. The first was the income statement. Remember, that's where we talk about revenue and expense. The second is the balance sheet. That's what I own and what I owe. And this one is the statement of stockholders' equity. This is a huge snooze fest, but it's important because it does have some information in it. Let me go back to the balance sheet again. Here's the stockholders' equity. So that's on the balance sheet. What we've decided to do is create this additional statement that's going to tell the reader how stockholders' equity changed from the last time we reported, which would be the prior year, to this time. So it's a resource to help them understand what's changed. So you'll notice one important thing, every financial statement we look at, the name of the company is always at the top, along with which statement it is, and for the period ending. Now technically they should have the year on here. The textbook probably just doesn't, because they want to make it look like it's current. All right, so we've got columns, a common stock column, retained earnings column, and a total. Remember, those were the accounts we saw. We saw a common stock account and we saw a retained earnings account inside the equity section. The ending balance that we're going to come to down here at the bottom is going to equal what we saw on the balance sheet. The beginning balance is where we started at the beginning of the year. We don't see that on this year's balance sheet. We would see it on last year's. It looks like this company was brand new. So at the beginning of the year, they had nothing in any of these accounts. At the end of the year, they had, we can see $25,000 in common stock, $1,000 in retained earnings. Does that match our balance sheet we just looked at on the previous page? Let's see. Dang it. Yep, it does. 25,000 and 1,000. All right, so now how did we get from 0 to these numbers? Well, we can see we issued common stock. What that means, we decided that we wanted a shareholder. So we gave them common stock, which entitles them to decision making and ownership of the company. They gave us $25,000 in cash, and we're going to record issuing that common stock here. Next, we had income. That increased retained earnings. And then we had dividends. Remember, dividends are where we give people back, people that own the company, a little bit of money. So showing those transactions takes me from the beginning of the year to the end of the year. That's all the statement of stockholders' equity is. Okay, let's touch on the last of the core 4, the statement of cash flows. This one is really interesting in that it is the most awful statement to put together as an accountant, because what you're doing is trying to tell the reader, here is where every single dollar we got in came from, and here's where every single dollar that left us, where it went. Imagine if I asked you to take 2019, and I said, hey, can you go ahead and tell me where every dollar you got came from, right? Whether it was parents, other relatives, jobs, etc. And where's every dollar where did you spend every single dollar, right? That's the nightmare of putting together the cash flow statement. So as an accountant, I loathe this statement. As an investor, I love this statement because it really helps you understand how a company is operating. The income statement sometimes can have a slight disconnect from the cash, and in later chapters we'll talk about why. So it can be important to understand where that cash comes in or where it goes. So inside the cash flow statement, we bucket all of those inflows and outflows into 3 buckets. The first one is operating, and this is probably one of the most important because this is truly how the company's running, right? Cash transactions involving revenue and expenses. So in our SNAP example, cash would come in from the advertisers. Cash would go out paying employees or paying for equipment. Investing means we bought some type of long-term asset that we'll use for longer than a year. That could be maybe we bought a bond we're going to have a really long time. Maybe we bought a building. That's investing. And then financing that means that we either borrowed money from a bank or some other formal source, or we sold more stock, right? We garnered more cash, we gathered more cash by selling a part of our company. That's financing. So I like the fact that the statement buckets these into the 3 because where do you want to see positive for sure? Over here in operating, right? My goodness, if somebody's not paying you for your service more than what it's costing you to give the service, that's a problem, right? Think about it. If you had a t-shirt that cost you, let's just say the t-shirt had a cost to you of $5, right? So you let $5 go out of your pocket to pay for that t-shirt, and you decided you're going to sell that t-shirt, you would not sell it for less than $5, right? Because if you did, well, now you've got a negative operating cash flow. No, right? In a perfect world, you're selling it for more than $5, hopefully maybe $10. And in that case, you have a positive cash flow. That's the kind of information we see in the operating cash flow. All right, so let's talk about SNAP again. All right, SNAP started in 2017 with $150 million in cash. Seems like a good bit of money. They ended 2017 with $334 million in cash. So if you didn't have the statement of cash flow and all you had was the balance sheet, because remember, cash is an asset that sits on the balance sheet, you'd say, well, that's all right. I like that. That's good news here. But when we look at the statement of cash flow, right, the statement of cash flow is going to tell us how they got from $150 million in cash to $334. How it actually happened is they had $734 million go out in net operations. What that means is when the advertisers paid them and then they paid for their expenses, they actually spent $734 million more than they brought in. So you might say, well, how can they do that? Did they overdraw their account? Well, what they did, and it's really these 2 things combined, is they got $2.3 billion in from something called an IPO. It stands for Initial Public Offering, and it's what companies do when they sell their stock to the public. So people like you and me bought their stock, right? So we got shares of Snap, and we gave them cash. So they got $2.3 billion cash in. They spent $734 million to fund their operations, and then they invested the rest. That's why you see this $1.4 billion out for investment. So while the cash went up, right, year, beginning of year to end of year, if we dig deeper in the cash flow, we see, it's not actually good news, right? You want a company like we used in our t-shirt example, right? Where was our t-shirt example? You want the company to sell, right, for a higher amount than it cost them. Oops. All right. But, in the tech industry, this can be normal for a while. I'll look forward to this semester, looking forward to see if maybe it's positive finally. if I pull up the actual statement of cash flows, look at all this detail. This is from what Snap filed to the public. This is a ton of detail about exactly what the expenses were, but we can go back, we can see the numbers I just had. 734 million out in operating, 1.4 out in investing, and that was primarily they bought some securities, and then 2.6 in from their IPO. So pretty cool. This is an example of a much more simple cash flow statement. But it's, without a lot of the detail that Snap gave us, it doesn't help as much. We can see in operating, well, good, we got cash in from customers. We paid cash out for salaries and rent. Oh, in this case, again, more cash out than in. Looks like we bought some equipment. That's more cash out. Well, how the heck did we do this? Oh, we issued common stock, which gave us cash in. We borrowed some money from the bank, paid a little bit of dividends, which is cash out. So we were able to end the year with $6,900 in cash because of those three things. All right, so last couple of concepts before this video ends. There's an order to your financial statements when you're preparing them, and you'll be preparing them a lot this semester. You always start with your income statement, right? And why do you do that? Well, because you need that net income number, hopefully it's net income and not a net loss, to go into the statement of stockholders' equity. Remember, that's where we rolled forward what our total equity would be. From there, I get my total retained earnings and I can update my balance sheet. My balance sheet tells me my ending cash, and I use that for the cash flow. So come back to this in the future. The first time I ask you to put a balance sheet and an income statement together, make a note to yourself to come back and look at this and help remind yourself the order. And then remember they link, right? So I'm going to have a balance sheet at the beginning of the period, right? My statement of cash flow is going to take me from the cash at the beginning to the cash at the end. My statement of stockholders' equity is taking me from my cash at the beginning, my equity at the beginning to the equity at the end. And then my income statement is all of the revenue and expense that I earned, which in turn made some changes to my balance sheet. And then again, we can just see those examples live on here. Income statement net income shows up, boom, down here on the statement of stockholders' equity. Statement of stockholders' equity shows the $26,000 in total equity that moves over to our balance sheet. And then our statement of cash flows uses that ending cash to reconcile out. So these things all link together and match. So that's the beauty of accounting. So I'm glad you guys watched these videos. Remember, you need to go back to my courses now and do the confirmation quiz. It's not a hard quiz. If you halfway listen to this video, you'll know the answers. But you need to do that confirmation to get credit for having watched the video. Excellent. All right, I'll see you guys in class.